Good morning, ladies and gentlemen. This is Bud Shorak, Options University. It's Monday, January 28th, 2013. Access to this video is for educational and informational purposes only. Nothing contained in this video, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Options University provides educational services that are meant to teach you the risks and rewards of trading stocks and options. We are not a service that tells you what to trade. We're not implying or guaranteeing any profit, and as always, do not trade with money that you cannot afford to lose. With that, let's take a look at the last week and see what's happened in this market and see how the trend has continued. And the first thing we'll do is we'll take a look at the indexes. And looking at the Dow, we see that the Dow was up 246 points for a 1.8% gain. Now, understand that's in 1 week, so that's the typical gain that you might see in a month or two or whatever. And so we see that's a hefty gain for the year. Year to date, the Dow is up about 6%. As we look at the NASDAQ, we see it also is up, not quite as strong because of Apple. Still up 4.3% for the year in spite of Apple. S&P 500 up 1.1%, and Russell 2000, which usually is a strong index in the month of January, as we see new money coming into the market, it was up 1.4%, and for the year both of them are up 5% and 6.6% in order. So we see that we've had a very nice month in the market, and the January effect has taken place, and we see that we had a Santa Claus rally, and all is looking well in Mudsville. Of course, the next thing that we're going to have to deal with is the debt ceiling, and that will have an effect on the market as we get closer and closer to that date. Looking at economic announcements for the coming week, let's take a look and see what we've got coming. And we see that we've got durable goods orders on Monday morning at 8:30 and pending home sales at 10 o'clock. And so those are things that can definitely move the market. Dallas Fed manufacturing survey, not quite as important. This is the week of the FOMC meeting, which of course can provide sometimes some really radical moves to the market. Don't expect big things out of the Fed at this time, as the status quo probably will be continued, and we see we've already had QE3. So FOMC meeting begins Tuesday morning, and we have Case-Shiller at 9 o'clock and consumer confidence at 10 o'clock. Both of these able to move the market. Looking at Wednesday, as we get to the toward the end of the month, we got ADP employment report, GDP coming out for the last month, and we see the FOMC meeting comes out at 2:15. So we definitely have news coming out on Wednesday. A big news week as far as the overall market's concerned. Jobless claims come out on Thursday. Equipment cost index probably won't move the market very much, but Chicago PMI certainly could be looked at. Personal incomes and outlays could be looked at 8:30 also. So there are big things on Thursday. Coming into Friday, motor vehicle sales, employment situation. So we find out what the month of January gave us, and we really could expect some big things coming out of that. We see that PMI manufacturing comes out, consumer sentiment comes out, and ISM manufacturing. So talk about a week with news and things that could really pop this market up to those previous highs from 10 years ago. Every day we get a new high. We get a new high for the last 5 years. We're headed for the high of the last 10 years here shortly. And with that thought, let's take a look at the SPX and see what the SPX looks like. And we say we are in an uptrend. We've been in an uptrend ever since the fiscal cliff announcement or whatever it was that they came up with. So the entire month of January has been one of irrational exuberance as the market and money have been come into the market. And so we are in an uptrend. We are in a uptrend basically since October. And so the market has moved. We had our bit of a pullback going into the fiscal cliff. But all in all, we got a nice track, so we can still continue to pull back quite a ways and still continue with that uptrend. And notice this uptrend has continued with Apple not even participating, as Apple has been a bit of a disappointment, which carried the market for the last few years. Now, looking at the SPX on a little careful, a little more minute basis, we see that Monday it was up, Tuesday it was up, higher highs, higher lows, some indecision on Thursday, and then another higher high and a higher low on Friday. As we saw every day, the market rose to new higher highs, going as high as 1503. So the market definitely is headed for that 1505, and then after that, where I think we're headed for around 1515. So headed for new highs as the market is showing real strength. The only thing that's going to get in our way at this point is the news, and we do have news coming as far as I had mentioned earlier, a problem with the debt ceiling, which of course we know they're going to solve anyway. I mean, it's not they're just going to keep right on spending, so we know that's coming. Next, looking at the Dow, we see that the Dow, which has been leading the market up, is up almost to 14,000. So the Dow looking real healthy as we see it is in a constant uptrend, getting higher highs and higher lows every single day. All right, looking at the NASDAQ, we see that it did not give us the same kind of moves as we have had some disappointments, and mainly with while the market has been going up, Apple, which really has a huge move in the NASDAQ, has come down, and so we see that the NASDAQ has not gone up at the same rate as the other indices. Russell, which generally has a very good January, we see that it is looking just as strong as can be, straight up since the fiscal cliff. Notice the 30 above the 50-day moving average, 30, 50, 200, standard uptrend, and our crossover took back quite some time ago on the 30 and the 50. Was back in December as the market made its move during the Santa Claus rally. All right, looking at the VIX, well, I've got a longer chart on the VIX here to give you context of where we're at over the last year. We certainly have had a greater highs where there's been fear in the market at times. This one, the most recent one with the fiscal cliff. But look at where we are now. Lowest that we've had in the last year, down in 12 numbers, which not a lot of fear in the market as the market just keeps plodding along. Also affects our volatility, and so it's harder to get premium out of the market if that's what you're looking for. All right, that explains some of the premiums. It explains how if you have certain guidelines to get into trades, you're not getting as much premium as you used to relative to the current strike price. At the money strike price, if you're a seller, having more difficult getting further and further away than you'd like to. But it's working. The trend is your friend, and it's continuing. It will stop, but it is not stopping yet. All right, next let's take a look at the bonds. Again, on a yearly perspective, we see that as the market has continued up, bonds are not at the lowest they've been during the last year, but certainly have come down to a support line. This is a support line that is a triple bottom. We'll see whether it holds or not. If we see bonds break through that, we could make money to the downside on bonds. And if we start seeing higher highs and higher lows and the market pull back, you might get a bounce out of the bonds. We're looking at TLT, which is our ETF exchange, to give us some indication of where this sector is going. Next, let's take a look at the financials, which have certainly led the market up during this entire time. Looking at XLF, our Spider Select sector, and we see that it is at all-time highs for the year. Certainly not at all-time highs for all time, but certainly for the year, as it has continued nicely with the overall markets, helping lead the overall markets up. And we see again the 30 above the 50, above the 200, and giving us a yearly high as it keeps following the overall market, which also adds a strength to the market. As we know, one of those strengths in the market is if you see the market running, you like to see the financials running with it. Now let's take a look at oil and see what happens with oil. As oil, looking at USO, our ETF for oil, we see that the USO is not anywhere near its all-time highs. Had a nice little rally here towards the end of the year. We got our 30-50 crossover right there, but you see we still are below the 200-day moving averages with the other two averages, so we have not really turned into a full uptrend, but we did get our crossover. We are in a bit of an uptrend, but not anywhere near previous highs. And if one were to draw a straight line, if you can imagine, you see that we are somewhere near resistance as oil could pull back with the overall market. So, or could pull back, or irrespective of the overall market, as it seems to have hit some kind of resistance. So watch oil carefully. Could be some money made to the downside here if it follows technical analysis. Next, taking a look at gold, we see that again. We're in an uptrend with gold, and then we had our crossover back here in November. Our safe haven lost some of its glamour, and as the market's been pulling up, look at what's happened to the gold as it's pulling back down to below that 200-day moving average. We'll see how far it actually goes below there. As our safe haven gold, GLD, our Spider Gold Trust, is in a downtrend. And finally, what kind of volume did we have during the last week? Well, looking at a yearly chart, we see that the spider looks very much like the SPX. Looking at a yearly chart, we had our crossover, and we see that we're getting new highs, and of course we're getting new highs for the past 5 years, headed for that 10-year high. And look at that volume, nice volume the last couple days of the week as we come into the end of the month, and we're showing that great January rally that all bulls love to see, and really bodes well for the next year. Now, cyclically, when you look at a presidential election, the first year of the election on a second-term president usually is not a strong year for the year. But, we've been depressed for so long. We fought off the housing crisis. We fought off the recession, both a U.S. recession and a worldwide recession. And there seems to be a bit of euphoria in the overall market. So we'll see where we continue to go. But there's nothing wrong with the volume as we've headed up during this last section of this rise in what looks like a bullish market. All right, with that thought, that is the week that was, looking at our major indexes, looking at our different sectors. I hope that this is helpful to you. Take these overall trends and put them into individual stocks, and you will see that you'll be in a position where you can not only play the indexes, but you can also look at your individual stocks. We had an interesting week in the market, and the week could provide an interesting move in the market as we come into FOMC and a ton of different announcements for the coming week. For those of you that are gold members, we'll continue with our list of stocks to watch. And for those of you that are not, thank you for being here. And if you're interested in more free videos from Options University, go to www.optionsuniversity.com/free gold. And with that thought, this is Butch Shorak. It's Monday, January 28th, 2013, and Options University, your educational company, is here to serve. Thank you.